advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. Our guest is Jeffrey Kleintop. He's the Chief Global Investment Strategist and Managing Director with Charles Schwab and Company. Jeffrey Kleintop is a CFA, and he is responsible for analyzing and discussing international markets, trends, and events to help U.S. investors understand their significance and financial implications. So, Jeff, before we dive into topics surrounding the state of the global economy, inflation, and the strength of the consumer, let's begin with more broad and general considerations. You encourage investors to think globally, not purely with their home country bias. Let's take a moment to offer some rationale as to why it is that U.S. investors and their advisors counseling them should be including foreign investments in the portfolio construction, and to what extent relative to U.S. investing.
Sure, Chris. Well, thanks for having me on the show here. I'm thrilled to be spending some time with you.
I'm thrilled to have you here, by the way. We're in the midst of our transition from TD Ameritrade to now the Schwab platform, which is undertaking, momentarily. And one of the great things that I'm enjoying already is the benefit of all the thought leadership coming out of Schwab, including yourself. So thanks for being with us.
Happy to do it, and thanks for your confidence. Look, international is something that many investors have shied away from in recent years for many reasons. Probably the main one is it's been out of favor for almost a decade. Everywhere I go, Chris, I see home bias. Investors have most of their stock portfolio in companies headquartered in their home country. Now, I'm Schwab's global strategist, so I travel a lot. The US, the UK, China even. And everywhere I go, people have 80%, 75, 80% of their stock market assets in their home country. This is true when I go to London. It's true when I go to Beijing, Australia. It's even true in countries like Greece. Is it a good idea to have 80% of your money in Greek stocks? No, it isn't. But it's what everyone does. It's more familiar, so it feels, I guess, safer to have your assets close to home. But let me give you an example. Nestle versus Coca-Cola is an example I like to use, because you can't simply invest in U.S. companies with international sales and get international stock exposure. Like you can't invest in big companies outside the U.S. that have a lot of U.S. sales, like say Toyota, for example, and get U.S. stock market exposure, right? Toyota sells and makes more than double the number of cars in the U.S. than it does in Japan. Does that make it a U.S. automaker, right? So wherever they're headquartered—
Where's the line, huh?
Yeah, right. So wherever these companies place their headquarters, if they're in the same sector or industry, they typically serve the same customer base. Let me get back to the Coke versus Nestle example. Nestle is a Swiss headquartered company. It's the biggest stock in the IFI index, International Stock Market Index. And it sells beverages and snacks to people throughout the world, just as Coke does. They have operations throughout the world, just as Coke does. In fact, these two companies have the same geographic distribution of sales by region, within a few percentage points. The Americas, Europe, Asia, Africa, they're all very similar. They overlap in a very similar way. They have different brands, but they're selling beverages and snacks to literally the same people around the world. Now, in the first quarter, I haven't seen the Q2 numbers yet, but revenue growth for Nestle from a year ago was 5%, and for Coke it was 4%. They're always within about 1% of each other. Unsurprisingly, no material difference given the same customer base. And that would suggest, Chris, that there shouldn't be much difference in the performance of the stocks in the same industry, headquartered in the US or outside the US with the same customer base. But in truth, there is a difference. The difference may not be in their sales growth or earnings. It might be in the investors themselves. And this is key to understanding why it's important to have international stock exposure, not just sales exposure. Nestle trades at a price to earnings ratio 3 points below Coke. US investors are just more optimistic than European investors that have had a war and a recession over the past year. Nestle doesn't always trade at a discount. Sometimes it trades at a premium to Coke, but it depends how investors are feeling. And like I said, 80% of those investors are close to home, right? So 80% of the investors in Nestle are in Europe. 80% of the investors in Coke are in the US. And that means that if that gap begins to close as maybe that optimism changes a little bit or we start a new cycle, we could see that gap begin to close. In fact, Nestle's up 9% so far this year. Today's July 27th, relative to Coke, which is flat. I'm measuring this in dollars. So I'm not recommending either of these stocks, Chris. I'm just illustrating why international stock exposure doesn't mean international sales exposure isn't the same thing as international stock market exposure.
That's a good point. How should investors, like, there's issues relating to currency and governments and different accounting practices. I mean, it becomes challenging for investors to think in terms of like all the narratives to be attuned into as they think about including foreign exposure. I mean, I suppose that makes an argument for managed over indexed, perhaps. But how do we think about these issues? How should we make sense of these kind of considerations as we approach this topic?
Yeah, there are a tremendous number of considerations. It's literally a full-time job. It's literally my full-time job to stay on top
Absolutely.
of all of these things, right? And so, yeah, everything from geopolitics and currency and the relative global economic picture versus that of the U.S., all the different companies, the different sector exposures that companies have around the world. I think you could get bogged down in the details, but let me try and simplify it in one way. People often ask me, what's the right allocation to international stocks? And I'm going to say, I give the same answer, probably higher than where it is now. After a full 10 plus year cycle of underperformance, it's likely many investors have let the international share of their portfolio wither a little bit here. What I like to do is recognize that there are cycles to investing. There are periods where US stocks outperform and long periods where international stocks outperform. Those tend to be defined by different economic cycles. So for example, in the 1980s, international stocks were the place to be, led by Japan. Incredible outperformance. US stocks didn't go down in the 80s, but international stocks outperformed by a tremendous margin. And then we got to the 1990-91 recession, and that really reset the clock. The leadership in Europe was overextended, valuations were very high, earnings expectations were very optimistic. And that reversed. In the 90s, US stocks outperformed as the PEs in Europe came down a bit. It was all led by the tech sector in the US with the dot-com boom. And US stocks led during that 1990s cycle until the recession of 2001. Again, US stocks were overvalued at that point. Expectations were too high. And that reversed. And international stocks outperformed in the cycle from 2001 to 2008. And then, of course, we know we got another recession, the great financial crisis, and the clock reset again with US stocks outperforming. Now I think we're resetting that clock. I do think we're experiencing at least a mild global recession right now, and that is resetting the clock to international stock market outperformance. We're seeing leadership there based on lower valuations, much lower valuations. In fact, one of the widest gaps in valuations we've ever seen. So US stocks much more highly valued, international stocks below their 20-year average on price to earnings ratio basis. Stronger earnings growth, better performance is beginning to show up. In fact, this year, the average international stock is outperforming the average US stock based on those equal weighted indexes. So we're starting to see that rotation begin to take place. I think many investors won't recognize this for a few years down the road, look back and recognize, oh, that was the turning point, as it always is every cycle. But we're experiencing that now, I think, and I think it is time for investors to reconsider their international exposure in their portfolios.
Do you think typically investors should think in terms of country-specific approach to things, or more broadly, as they think about how they implement these opportunities?
I think when international is out of favor, there are sectors or countries around the world that still outperform, right? Just broadly, they underperform. So then you want to be more selective. Find those unique opportunities, whether it's a particular sector or country that's really standing out. Now, I don't think you need to do that. We've seen a rotation into broad international outperformance, and that means you don't have to take on that sector-specific or country-specific risk that you would get by really just focusing down. Sure, there are some countries that are doing better than others right now. There always are. But I think a broad international allocation through those broad mutual funds or ETFs that offer that exposure is probably the best way to go.
You mentioned in passing geopolitical risks, and this was one of the areas that people had asked me when I mentioned I was going to be talking to you, to ask you about, how do you quantify, manage this kind of concern? I'm sure it's sometimes overblown because we focus on, news related topics and there's a lot of political dimensions to these kinds of issues that tend to work their way into these conversations. But, before Russia actually did invade Ukraine, I'm sure we were thinking, well, the likelihood of that's pretty low. And today people worry about Taiwan and China, and I'm sure other things as well. But how do you kind of navigate what's real in terms of its significance and relevance as an investor from what might be hype or over anxiety?
Yeah, I remember back in our outlook for not this year, but the year before, one of the top 5 risks we talked about within geopolitical risks, the risk of a Russian invasion of Ukraine before it happened. There's always these types of risks, and we try and illustrate those not only when we give it an outlook for the year, but then what are the risks to that outlook? And geopolitics plays into that. This year, weather may be playing into that. There are a lot of different factors. The war in Ukraine is an example of why geopolitical risks are an ever-present part of investing. There are often conflicts involving major oil producers, almost every year, every other year. And the effects are generally felt in the energy markets as they were last year. But geopolitical risk isn't limited to international markets or military actions. There have been a lot of global risks emanating from the US this year. The US debt ceiling scare, the US bank failures, among others, have delivered US generated volatility for foreign markets. I often get asked about China invading Taiwan. Taiwan is due to hold its annual military exercise next week, during which it drills for preventing an invasion by China. And so the Chinese army has sent, just this past weekend, 37 aircraft and 7 Navy vessels around Taiwan to kind of just harass them a little bit there. But despite all this posturing, a conflict seems pretty unlikely, at least in the near term. And here's why I think it would be economically impactful for sure in many, many, many ways. China is so deeply integrated to the global economic system. Taiwan Semiconductor makes the best chips in the world that we're also dependent upon. So this would have major implications, not just through slightly higher oil prices. So this is a big deal. But I think a conflict is really unlikely. The latest survey published about 2 weeks ago, done every 6 months by Taiwan's National Chengxi University, provides great details on Taiwan's sentiment on independence versus unification with China versus the current status quo. It goes back decades. Currently, only 5%, specifically 4.5% of the population is in favor of declaring independence as soon as possible. The media makes it sound like they're about to do that at any moment. 5% of the population. The top response at 32% was for the status quo indefinitely. And that was similar to another response, status quo for now, and decide another outcome at a later date. If you add those two together, it's over 60% of the population, a majority for the status quo, which is also fine with China. Only if we combine those who want to move immediately towards independence, that 5%, with those who want to maintain the status quo for now, but maybe move to independence over time, we can get to about 26% of the population. That's a significant amount, but nowhere near the overwhelming majority it would take for Taiwan's democratically elected leaders to declare independence and welcome conflict with China. I mean, there's other factors that could elevate the threat of military action, like formal defense agreements between Taiwan and the US, or Taiwan being admitted as a peer to China at the UN. Those aren't even being proposed by the most ardent anti-China members of Congress. So I think there's a lot of reasons why conflict doesn't appear likely in the near term. Certainly it would be devastating if it did, so we've got to consider it as a risk, but I'd put a very low probability on that, despite how the media makes it seem they're on the brink of declaring independence and a Chinese invasion is imminent. But all this makes it important to remember that geopolitical risks are an ever-present part of investing and aren't necessarily higher today than in the past.
And China particularly is one of these places that people have some anxieties about to what extent to include in their investing. Just quickly, could you comment as to whether you think there's validity behind that kind of an anxiety?
I mean, I think the anxiety can be come from multiple dimensions. From my perspective, I think there have been some concern about, can we get honest data from China on its economy, on its companies, and I think that has improved dramatically. As a matter of fact, the accounting auditors, the auditing oversight board in the U.S. declared earlier this year in February that yes, in fact, U.S. Auditors are now able to get full access to the books of Chinese companies. They went over, they verified that threat of delisting Chinese companies from U.S. exchanges because they couldn't audit the results is gone. So they're reporting using the same global auditors, KPMG and EY and all the others that U.S. companies are using. Those books are now open. So I think that issue has faded to a tremendous degree. Two, there's just questions about this tension between the U.S. and China. That's a tension that's probably going to linger for quite some time. That said, I think a strong private sector in China is important to, helping China continue to move in the direction of a better environment for its citizens, a more engaged environment
toward a
with the
more
global economy.
open society, kind of.
Yeah, there you go. We'll sum it up that way, perhaps.
We're talking with Jeffrey Kleintop, Chief Global Investment Strategist with Charles Schwab. Jeff, you mentioned in passing the idea of we may be in a mild global recession, and you had an interesting article recently talking about the impact of climate in Europe in particular, and concerns about, I guess I took from that what maybe there's a concern that could have some inflationary consequence because of some of the limitations that's having on that part of the world. Yet at the same time, it sounds like you're expecting interest rates to stabilize and not necessarily change a whole lot. Can you speak to where do you fall in all that process? Where are we in this process with Europe and recession and interest rates, and what's to be expected?
Yeah, I think that's the big question that central bankers are grappling with, investors are grappling with. Certainly, we're going to get second quarter GDP next week for the Eurozone, but it's official that Europe entered a recession in Q4 and Q1, back-to-back negative quarters for GDP, the mildest ever at just negative 0.1%. But that isn't too surprising. We talked a year ago about how Europe was the most vulnerable economy to a recession, in part because of the war. But it's also too much of a generalization. During the typical global recession, global, not just Europe, global, all areas of the economy, like manufacturing and services and trade and retail and construction, they all tend to turn down at the same time. But over the past year, it's really only manufacturing and trade that seem to be in a global recession, including in the US. On a global basis, we can see that in indicators like industrial production, which is down from a year ago. Worldwide trade volumes are down. Job growth by industry, we've seen manufacturing job losses in the US. Surveys of purchasing managers at manufacturing companies, many other ways. So I'm referring to this, Chris, as a cardboard box recession, because things that are manufactured and shipped tend to go in a box. So if it can go in a box, it's in a recession right now. If it doesn't go in a box, it's actually doing okay. And demand, the other reason I'm calling it a cardboard box recession, is that demand for corrugated fiber board, which is what most cardboard boxes are made from, has fallen similar to what we've seen in past recessions. So we've got that weighing on the economy. Services are doing okay. Services, education, travel, transportation, leisure, financial services, healthcare. These areas are doing okay, although they've been weakening a little bit lately based on some of the surveys and some of the data that we're seeing. So I'm a little concerned about the service sector perhaps weakening in the second half of the year. And the bad news there is that it might weaken the job market. In the US, we have 10 times the number of services jobs than we do manufacturing jobs. So if we start to see the service sector begin to soften up, we could see more job losses. And as we're going through the earnings season, I'm hearing a lot more about layoffs and workforce reductions, than I am about hiring and jobs being hard to fill and worker shortages and that type of thing. So I'm a little concerned about that. But to wrap this up with what it means for inflation, it's good news for inflation, right? The slowing economic picture, particularly in manufacturing, has meant that prices have come down. As a matter of fact, most places around the world, inflation is falling as fast as it went up. And there's kind of a misconception that inflation is remaining very stubborn and very high. And on a core basis, maybe. But if you take a look at just headline CPI, it is really coming down very rapidly. And one of my favorite leading indicators is the Purchasing Managers Index. Is a survey within that of business leaders asking them about pricing. And that usually leads overall inflation by 6 months. It does a great job. They're all pointing to numbers around 2% by the end of the year. So I'm encouraged that what we saw this week with the Fed on Wednesday, European Central Bank today on Thursday, means probably those are the last rate hikes we're going to see this cycle.
So do you think that it's sort of a bifurcated, depends on which part of the economy you're looking at, but does this create some spillover worries for U.S.? You kind of indicated there's a risk of that, but does this, are you concerned that the U.S. might be headed toward a recession?
Yeah, I mean, I think, we get caught up in this definition of a recession. I think we've been more nuanced about it. I think we're in a rolling recession. And in 2020, we were in a services recession, right? You couldn't travel, you couldn't go anywhere. Disney World was closed, for heaven's sake. So we all shopped from home and manufacturing was booming. Now, a couple of years later, we're getting the opposite of that. Now everyone's traveling and no one's shopping. So manufacturing is down, consumer spending is weakening, and services are booming. Just try and book a reservation at your favorite restaurant or get an airline ticket. I live just a few miles from the gates of Disney World. There's no recession at Space Mountain right now. Let me tell you, I was just there last night. Lines are as long as ever. So, so what we're seeing here is the second half of the 2020 recession. That recession was 2 months long. This one is the other part of the economy. Whether overall economic growth turns negative or not, I can't say, but I can tell you if you put the two pieces of this together, what you get is a mild overall recession in the U.S., globally speaking, I think. And the semantics of, does the National Bureau of Economic Research ultimately define this as a recession? Of course, they only do so after the fact, so we don't know when we're in it. We only know when it's over when they actually define it. But yeah, I think we're probably experiencing that. I think the globe is probably experiencing a very mild recession right now. And of course, that comes with some negatives, but it comes with the positive of resetting the clock on market performance and shifting the market's leadership. And we get, refreshed market leadership when we're looking outside the U.S.
Where do you see the biggest risk for investors right now? What's on your radar?
Well, I mean, I just talked about this potential slowdown in the service sector in the second half of this year, and maybe weakness on the job front. I think those are areas that the market's not expecting, and we are seeing indicators that 3 months in a row now of the services Purchasing Managers Index, so survey of business leaders in the services industry, coming down quite sharply. At the same time, hearing more about layoffs from business leaders. Tighter financial conditions tend to lead to layoffs with a little bit of a lag. Cash flow at corporations is falling, and when it does that, that generally leads to layoffs. And we're also seeing a rise in business bankruptcies. That all tends to point to layoffs as well. So I'm looking at a weaker job market in the second half of this year, perhaps further weighing on the economy. Doesn't mean we necessarily get negative overall GDP, but maybe the service sector starts to weaken up. But I think a risk to that, let's say, mild growth or sluggish growth scenario is something worse. And it could come from an area we don't usually think about: weather. Weather rarely has a material impact on overall markets, but that could change in the coming quarters as the potential for extreme weather, heightened by El Nino, could cause some significant economic disruptions, and comes at a time when the global economy is already vulnerable to a shock. The World Meteorological Organization has put a 90% probability on an El Nino event this year, when the Pacific Ocean surface warms up and it creates some extreme weather patterns. We're already feeling extreme heat across the U.S. That's no surprise to anyone on this podcast. Hottest week ever for the entire planet in the beginning of July. And the problem is airlines are being forced to use more fuel due to the heat and the less dense air. Hospitals in the Southwest are seeing the most emergency room cases since the pandemic, tied to that heat. The lowest water levels since 1969 in rivers like the Rhine in Germany has made it impassable for most barges carrying coal and cargo. Rivers in France are too hot to cool nuclear reactors, leading to energy supplies being cut. And Ukrainian wheat, which now can't be transported via the Black Sea, Russia's made that clear, would now need to go by the Danube River to Europe, but the river's dried up and unable to allow those shipments to pass. So the impacts, and wheat prices have spiked, rice prices have spiked, cocoa prices because of heavy rains in West Africa because of this effect has had an impact there. So these weather disruptions could affect food production, impact the movement of energy and goods, cause hurricane losses. Yeah. Anyway, I could go on and on and on, but weather is difficult to forecast, obviously, as are markets, but the potential impacts here of a shock to the economy are worth considering by investors.
Very interesting and a little unsettling at the same time because of the potential consequence of that. Valuations, you touched on the fact that I just wanted to bring it back to U.S. a little bit. We've seen the U.S. market seems to have gotten a little extended, particularly when you look at large cap growth. You mentioned relative to foreign markets that they're much cheaper. Do you look at other aspects of certain areas of the markets that we should be kind of putting new attention to, or is it more thinking about U.S., non-U.S.?
I think at the broad level, I don't think you have to get any more complicated than that. I mean, international stocks are trading below their 20-year average PE. U.S. is trading at 19 times earnings versus a 15.5 long-term PE. So very expensive. I would say the U.S. stock market is close to being priced for perfection. And I think international stocks are priced for imperfection. And I think it's going to be an imperfect environment in the second half of this year. But if we're looking for areas to focus on, one reason international stocks have been faring so well is that the best stock market in the world so far this year is in Japan. Japan is home to the world's second largest stock market. Believe it or not,
great?
I know.
Yeah, wow, it's been a while, right? Yeah,
it's been a long while. I think the typical investor might say Japan lost decades, right? Referring to the Japanese stock market failing to recover its peak back in December of '89. Chris, that's a long time to go without a new high, 1989. But investors are taking another look. Japanese stocks show signs of finally closing in on a new high after more than 30 years. And there are a few reasons why. One, there's a change on the stock exchange, the Tokyo Stock Exchange, forcing companies to shed some cash to implement some pro-shareholder reforms to improve returns there, improve price to book. Companies in Japan tend to hold, many of them hold more cash than they have liabilities. I mean, they have net cash, and that's just earning less than zero. In Japan, they didn't hike interest rates. So they're literally earning negative interest rates on that cash, but it's bloating their balance sheets. So they're turning around using that for buybacks and dividends. That's a plus. Japan's GDP growth outgrew the U.S. in the first part of this year, actually showing some strong growth there, in part because it's benefiting from the de-risking of supply chains in Asia and a shift from China into Japan and other countries as well. In fact, we just a number of semiconductor companies relocating or ramping up their factories in Japan. So a lot of reasons behind that, helping Japan be the best performing market this year.
That's outstanding. Jeffrey Kleintop, I know we've kept you longer than we should. Thank you so much for your time today, and appreciate your expertise and insights. We hope we'll have a chance to talk to you again.
My pleasure, Chris. I get excited talking about these things, but thanks so much for the opportunity and look forward to doing it again.
Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.